today's state of the markets, really, this is something that we like to give toward the beginning of the year, but we've been really busy here so far with some other stuff and a lot of fallout actually going on, dealing with things. So we'll go ahead and get started here. Take a minute to read those disclosures. Nice information. And again, questions. So just take a minute. I think that your questions will be at the very bottom, Q&A, so you can start that. And I'll get those at the end. I can stay as long as you need me to at the end there to answer questions, so I'm happy to do that. So as we go along, you may have some. Well, we're going to talk about 2020, and then we're going to talk about what we think is probably going to happen going forward, and we'll see. But when we think back on 2020, I think there's probably one thing that we can't agree on, and that's this little guy right here. He got in the way of a lot of stuff, ruined a lot of lives, killed a lot of people, lost a lot of jobs. And we have kind of pulled together as a worldwide society to fight this thing. And I know that there's about 1.2 million people getting vaccines every day now. So that's really great. I know a lot of you have gotten vaccines. I know a lot of you have gotten your second shot, and I know it's been 10 days since then. So very happy about that. We can look at the stock market. You can see it was a huge precipitous drop off back in March. Everybody remembers that. You had been asleep. Some COVID-19 dates. We watched it evolve from China, and then it kind of was skirting South Korea a little bit, and it made its way over to Italy, if you remember that. And Italy was in bad shape, and then made its way to Spain, and then finally hit the United States on the West Coast. Oregon, Portland, Washington, and then finally it hit New York City, and it really just devastated New York City. And then from then it hit the rest of the country. So by March 15th, we were at our 16th, we were at our all-time low there. You remember maybe the oil prices had dropped out just of the ceiling, and you could actually, if you had a tanker, and I wish I had a few oil tankers, that you could have pulled up your oil tanker and they would have filled it up for free because they just were running out of storage. So I think that was something that no one really saw coming. They didn't see that even when we heard about it in China and got out of Wuhan and stuff, we never really thought it would be a worldwide epidemic like it turned out to be, and it was just devastating. So a lot of things happened there. We'll talk about, what the Fed did, but just here quickly, you can see that, even though it devastated the second quarter, by the third quarter, we were pretty well recovering. And corporate earnings still were moving along. We had the CARES Act, the $2 trillion that was injected. And then, of course, I'll show you right now what the Fed did, which, we have to admit probably did save maybe the world economy, because it was plummeting at that time. Obviously, they cut rates way down, all the way back almost down to zero. The quantitative easing that's been going on. And remember, quantitative easing is another word for printing money. And what they do is they have these asset purchases. So the Fed comes up with some money, and the Treasury comes up with some treasuries, and then they just swap. And that's what they mean by asset purchases. They're not really buying any true assets, although you could say a treasury is an asset. But even though they're just kind of making it up. I don't remember if you guys remember the repo market spike, which was the overnight lending between commercial banks. And that spiked up to like 8%, I think, one night, when it was, normally under 1%. So that was pretty scary. So the Fed stepped in and boom, 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 right after one after another, cut the rates down, started the asset buying, which is, flooding the economy with money so that there's not a lockup in credit. The money market mutual fund. I don't remember if you remember back to 2008, but remember money markets actually, they broke the buck, meaning that $1 in the money market was no longer worth $1. And that was scary for a lot of people because they had really never seen that or lived through that. They did some things to establish support for credit for large businesses, and they actually went in and started buying some bonds up. Remember the Paycheck Protection Program? I don't know with this new bill if there's new stuff like that coming out. I hear that there are some new things coming out. And the Main Street Lending Facility, which is, all those Main Street banks that little mom and pop guys that needed some help there too, because they were hurting. But in the end, everybody made it through for the most part. I mean, there's a lot of restaurants and other things that didn't make it through, but in terms of the financial system, it held up pretty well. Obviously, the biggest thing is the dropping those Fed funds rates. You can see that, after 2016, market's doing pretty well. Maybe inflation is starting to rear its head a little bit, and we feel confident enough that we can start raising rates. And so that's what they usually do, start raising rates like that. And then when we have a big market drop like we did, they drop rates way back down. And so we're basically somewhere between a 0% and a quarter of a point. Not very good for savers, people who are living off fixed earnings, people who are living off CDs or saving accounts. I mean, your checking accounts, your savings accounts, they're just not earning anything. Money markets, they're just not earning anything. And it's forcing people to take on risk that they otherwise would not take or have to take. That's one of the negative things about low interest rates. It punishes savers. Looking at corporate earnings, because corporate earnings are what really drive the market. If we can see, 2000, right, and here's 2018, 2019, the first quarter there, 2020, you can see everything turned negative. So we were not, we didn't have a lot of huge growth even in 2019. And then when the COVID hit, we were pretty ripe for a drop. And that happened, as you can see, in the second quarter of 2020. Third quarter of 2020, and then finally by the end of 2020, things started turning around. So those are year-over-year growth rates of corporate earnings. So they have a tendency, because they're averaging, they have a tendency to lag. But corporate earnings were already positive by the third quarter of 2020, which is amazing, really, if you think about it. We take a look at a few of the different sectors of the economy. Obviously growth, GDP growth was way down in the second quarter, but obviously you can see it snapped back a good bit in the third quarter. The labor market, inflation has always been sort of tame, and we'll talk more about inflation later because I've got something to say on that. Consumer confidence, it's interesting that consumer confidence was higher in the second quarter than it was in the fourth quarter, but who can explain consumers anyway? Manufacturing looked like it took the worst hit right there, and manufacturing is one of our leading indicators. We're going to talk more about that later, but manufacturing obviously did take a hit, but honestly not as bad a hit as you would expect. Obviously, certain industries did better than others. Certain sectors really got hurt. Aerospace, the cruise industry, oil took a big hit. Hospitality, resorts, casinos, movie theaters, all those kinds of things really took a hit. So let's just do a little comparison here. Let's go back to 2010, a little over 10 years ago, and you can see things were looking pretty rosy. We had our global economic outlook, that was good. U.S. economic outlook, good. Equity market valuation, good. Labor market was good. The only thing that was really negative is, we had volatility levels. The market was volatile, but when you have markets that are this large, we're at Dow 32,000, you're going to have, a 1% move is 320 points. So that could be, you're going to have volatility when you get to these levels. Political environment, what do you know? That's negative. I don't know if there's ever been a positive political environment. So let's fast forward now 20 years to January 2020. And you can see a lot of those colors had turned yellow, and it was sort of a warning sign, like the economic outlook, the yield curve. Remember, we had talked about the yield curve and the flattening of the yield curve, meaning that longer term rates were paying roughly about the same as the shorter term rates. And in some cases, shorter term rates were paying higher than longer term rates. That's not supposed to happen. So that's sort of a telltale sign of something going on. What do you know? Political environment's negative, and geopolitical risk is negative. I mean, those are always sort of ever-present problems. Inflation, not a big problem at the time. Interest rates still relatively low. Consumer spending. And remember, consumer spending is a huge part of our economy. Without that, we're going to have a bad season. But luckily, Americans love to shop, and they're good at it. And I know that members of my family help out, and I do too. So I can't blame anyone else. especially these days when you got nothing else to do. You got to get out there. I've noticed a lot of you have been taking out withdrawals to fix your kitchen or fix your garage or paint the house or repair the driveway. It's interesting. So a lot of withdrawals going on, but that's okay because we're at the top of the market and it's the time to do it. Here we are in November 2020. So you can see still a lot of things have turned yellow. A lot of things are red, and geopolitical risk, obviously always red. Political environment, nobody's happy with the politics going on. Disposable personal income, now that's the one, that's the biggie, because if you can see, you know, prior to that, it was yellow, even green, where consumers were spending. And when disposable personal income goes down, then that means that there's probably going to be less shops to the malls, which the poor malls are just being devastated, but maybe, you know, fewer purchases on Amazon or whatever it may be. So when we look at disposable personal income going down, we have to expect that potentially shoppers may shop less. I have some clients that no matter what, will keep that in the green, and you know who you are. Now, let's talk about leading economic indicators. Now, I got to say, this is put out by the Conference Board, so you can go there, conferenceboard.org, and look and see what the leading indicators are. But what they're telling us here is, hey, leading indicators have never been negative going into a recession. In other words, leading indicators have always told us that, you know, where we are. But if you look, you know, this is sort of a recession. Well, this is a recession right here. And the leading indicator, yes, it did start to drop there, but the market had already dropped. You know, I was curious about what they're talking about leading indicators, and I figure you may be too. So I pulled it up, and we did a little research here on the leading indicators. Now, there's 10 of them, so let's just go through these real quick. So average weekly hours manufacturing. Well, that's a current indicator. That doesn't tell anything about the future. Average weekly initial claims for unemployment. Well, that's a current indicator. That doesn't tell anything about the future. Manufacturers' new orders. Okay, now that could be real because those are new orders that are people putting in. They think that the future is going to be good because they've got orders going in. So I will go with that one. Index of new orders. Okay, I think new orders makes sense. Manufacturers' new orders. Okay, that makes sense. Building permits. I think that makes sense. Stock prices, current stock prices. What can current stock prices really tell you about the future? I don't think they're very much there. Interest rate spread. Again, that's the current interest rate spread between the 10-year Treasury and the Fed funds rate. What can a current rate spread tell you about the future, other than maybe there's some issues going on there with bond buyers, which, as you've seen, has been happening here recently. We're going to talk more about that. And then average consumer expectations for business conditions. I mean, really, can I ever really take consumer expectations and learn anything from that? No. So of these 10, I would say half of them are probably real, you know, and half of them are just maybe fluff. But that's why you have to look into these things. You just can't take anything for face value. Now, going on in the future, you know, clients always tell me, well, that's great. You told me what happened last year, but, you know, what's going to happen next? Well, no one knows what's going to happen next, but I can tell you, if you read my recent letter, which is Pedal to the Metal, you can find it on MagellanPlanning.com under newsletters, Pedal to the Metal, and you can see some charts there where I outline how much money has been created and how much credit has been expanded, and now our bank ratio reserves are just gone completely. That's right. That means that banks that used to have ratio requirements, reserve requirements, no longer have any reserve requirements whatsoever. That just happened last March. So headwinds, these are things that are working against us. The COVID-19 vaccine distribution, you know, how fast is that going to get out? I just heard yesterday that by maybe June, every American adult will have a vaccine available. So that's, I think, positive. Very good, very good. Economic scarring, you know, you see that all around. Some of my favorite restaurants are closed. The Downwind over at PDK closed. California Pizza Kitchen, that closed. There are several around that, you know, places I went to forever that just love, and they're gone now. So that's economic scarring. Not to mention that a lot of stores you've seen in shopping centers and in the malls have closed down. Here we go, rising bond yields. You've heard about this. And when bond yields started rising, treasury yields primarily, what happened was the market dropped a good bit. Now, it's a little misleading to say that they're rising bond yields, because yes, the bond yields did rise, but the bond yields only rose because the bond prices fell. Okay, so we're talking about treasuries mainly. Bond yields will go down when bond prices go up. It's an inverse kind of thing, like teeter-totter. So if there's a lot of people out there who sell their bonds all at once, the price of the bonds will drop. When the price of the bonds drop, the yield, the current yield on those bonds will go up. So if a bond is paying 3% at par, meaning that's what it's issued at, that's what it matures at par, and that price of the bond drops from 100 or 1,000 down to 900, okay, then you can see that the interest rate that was pegged to that would be higher. And that's what really happened, is bond prices fell. And as bond prices fell, yields went up. That's what really happened. Now you have to ask yourself, why did bond prices fall? Well, bond prices will fall when there's more supply than demand. That's just basic economics. So a lot of supply of bonds out there, and maybe there was more demand and now maybe there's less demand, or maybe somebody's selling a lot of bonds, maybe China or Russia. I think Russia has sold all their treasuries. Maybe China is doing that now. We'll see. I don't know. Finally, geopolitical events. That's always on the thing. You know, when we change presidencies, we change administrations, there's a few characters that always pop up and want to see and sort of challenge, you know, the new presidency, challenge the new administration. One of those is North Korea. Haven't heard from them yet. Another one is China, you know, and they're always eager to get back into Taiwan. They don't like to talk about Taiwan. They don't want you talking about Taiwan. They consider Taiwan as their own. And then you saw the 9-point line down there in the South China Sea. So China is sort of, you know, going back down into that region. And we'll see what happens with Iran. I think they're in talks again, but you know, it's the same players all the time, sort of raise their heads when we go through these things. Tailwind. So these are the things that are helping us push us along to profitability and to positive outlook. Again, the vaccine, I think that's positive. I know that there's Pfizer and Moderna, and I think Johnson & Johnson's now coming up with some of those. And again, I know most of you already have yours, so that's great. Continued monetary accommodation, and we don't see interest rates going up very quickly, very soon, anytime soon. So corporate profits, corporations have still been profitable. So that's great. Again, people have still been buying, even though they're at home. They're doing Amazon, they're doing, you know, other things where they're having things delivered. So there's a lot of delivery going on. I know that in my neighborhood, I see the Amazon Prime truck 3 or 4 times a day just in our cul-de-sac. It's unbelievable. Healthier consumers. So I know that, you know, people are pent up at home. I can't wait for this to be over with. I can't wait for everybody to be able to get out. I can't wait for us to have another lunch and learn where I can see you and hug you and make fun of some of you and make jokes. I love that. So I really do not like these webinars because I don't get the feedback. And I hope some of you are finding the question and answer Q&A and will start sending me some stuff. So I don't see anything yet. No open questions yet. But one thing I would like to hear from you about, though, is when you would be willing to come back to a lunch and learn. Give me a month, October, maybe it's next January, maybe it's July. I don't know. Let me know what you think about when we could get back together, what you would feel comfortable with. I think a lot of you, after you have your second dose and you had some time for that to work its way into your DNA, your genome. No, it doesn't go into your genome. One of my doctor clients told me that the RNA stays out, does not go into the nucleus, so it does not become part of your genome. I hope that's true. I'm sure she's correct. Reduced trade tensions with allies in China. Maybe that's true. I know Russia, you know, who knows what's going on with those guys. So we'll just have to see. I don't know about that. I don't know what China's going to do. I don't know if they're going to be happier or not. They seem to still be pushing on Taiwan pretty strongly. And then moderate inflation. You know, moderate inflation, yeah, okay, it's moderate. We don't have hyperinflation, that's for sure. Our inflation rate is probably about 8%. If you want to think about when we used to calculate it in 1980, we had one inflation rate calculation that we used. We changed it again in 1990. So the Bureau of Labor and Statistics has changed the inflation calculation 3 times. Well, they've changed it twice. So now we're on the 3rd iteration of that. And if you go back to the first iteration of when we had that back pre-1980, the inflation rate using those old numbers is closer to 8%. There's a great website that you can go to find out these old numbers. It's called shadowstats.com, and a guy named John Williams puts that together. And just go to the front page, and up at the top it says alternative data. And in alternative data, you can see the different unemployment rates, you can see the different inflation rates. And again, it's the way that the Bureau of Labor and Statistics themselves used to do it. We changed the formulas along the way because we didn't like what they said. And what they said was we were having inflation. And right now, you know yourself, when you go to the grocery store, what is a carton of eggs? What is a carton of milk? It's more than it used to be, I can guarantee you that. One of the things that we obviously look at a lot is the price earnings ratios of the S&P 500. So if you read my last letter, Pedal to the Metal, you know that we're in a higher level of price earnings ratios than normal. Here is the last 20 years or so, 35 years of price earnings. And you can see that as of September 30th of 2020, our price earnings were about 21 times. So what that means, and I know a lot of you know this, but what that means is when the earnings of a stock take 21 years roughly to pay for itself. So if you had a stock that was a price earnings ratio of 5, that means that stock earnings would pay for itself within 5 years. That's great. 20 years is roughly about the average. So they're saying here that the 25-year average is about 16, 17. I think the 50-year, 100-year average is closer to 20. But what I did was I pulled up the Wall Street Journal, and as of last Friday, March 5th, right, the price earnings of the S&P 500 is 43.22. 43.22. So what that tells me is the valuations are very, very rich, and that is a typical danger zone. So that's one of the reasons that you've been hearing conservative overtures from us, is because a price earnings ratio like that always, and I can't say always, but history has shown that historically had always come back into the mean, always comes back into the mean. Now, if you look and you say, when were we last that high? Well, that was in 1999. And for those of you who remember what happened after 1999, remember that we had a huge market sell-off, especially where? In tech. And what's the all-time high right now? And where is all of this massive growth happening? Tech. You got it. So my word to the wise is, I know it looks good right now. I know we're pushing new highs. I think today is an all-new high. But you've seen this before. This has happened before. We're at PEs of over 43. It's not sustainable. And I know that you've got a new generation of people out there that were not around in 2008. You know, these people who were on, I forget the name, Robinhood, that are now on this website, Robinhood, that are doing, you know, the Reddit thing, and they're pushing these shorts up and stuff. You know, more power to them. I hope they do well. But when you get to that kind of irrational exuberance, as Ben Bernanke uses, not Ben Bernanke, or who was the other guy. When you get to that level, you realize you've got problems, and things may be coming. Because remember, in 2008, these guys were just in middle school, and now they're in the market. So they haven't lived through this yet, but you have, and we have. Some of you remember 1987. That's the first one that I really remember. So those are good years. COVID obviously is going to be a big part of our recovery. You know, it's just the way it is. But I think we're underway. I mean, I hear news every once in a while about someone, you know, dying from one of these vaccines, but I think it's very, very rare. So I encourage you to get your vaccine as soon as you can if you haven't already. And my wife is, you know, is from Brazil, and so I'm pretty sure that for any of us that are going to want to travel internationally, it's just going to be one of those things that we're going to have to do. They'll probably have a new vaccine passport where you'll have to show that you've been, vaccinated and before you're able to get on the plane or enter a country. I know right now that if you leave the United States that you have to pass a test to come back in, and then if you fail that test, you have to stay quarantined in the country that you're in. You can't come back in. That was true maybe about a month ago. I don't know if it's changed. So let's talk about forecasts for 2021. We're about a third of the way through it already. These guys, are the guys you always hear about, Morgan Stanley, Goldman Sachs, Credit Suisse, all those guys. And here's their end of the year 2021 target. And, they're all right about there anyway. We're about 3,900 as we speak. So unless things turn south quickly, these guys are probably going to be right on it. And we might hit 4,300. Or we might hit 4,500. There's no telling with all the money sloshing around and all the new money and all the new stimulus. We did $2 trillion worth of stimulus last year. We just did another 1.9 trillion. I'm sure Biden's going to sign it. So, money is flowing. There are no bank ratios, reserve requirements anymore. So banks can just do whatever they want. In terms of printing that money, it's all about demand. If there's a demand for free money out there, it's available. So, I see, crazy ideas coming up all the time. I see donut and bacon drive-throughs, donut and bacon. Okay. I see hair dryer bars. You don't get your hair cut. You don't wash your hair. You just go there and get it dried. Both of those, by the way, have failed. So, you see a lot of crazy stuff coming and going, and with all this free money sloshing around, that happens every single time. A few things that we look at in terms of inflation. And again, I want to talk about the inflation rate, that has changed. If you look here, the Bureau of Labor and Statistics.gov, that's where we get the current inflation rate. Again, the formula for figuring inflation has changed twice already. It was different in 1980, it was different in 1990, and then the one we're living with now is very different. You can see that food is one of those that has risen a good bit, and that definitely purports with my own experience. Energy obviously has dropped a considerable amount. No one's really traveling. The airlines are, on half staff. The cruise lines, I don't know what the cruise lines are doing. I get mailers all the time about future cruises starting maybe later this year. So that's a good thing. All items less food and energy, again, inflation is really closer to 7 or 8% if you want to be truthful. Unemployment the same way. Go to that website, shadowstats.com. Unemployment they're saying right now is around 10%. No, it's closer to 25%, closer to 25%, the way we used to figure it. And so, it's a little misleading, the numbers that they're giving us today. It's not as rosy as they say. Real gross domestic product, again, a lot of these are estimates. So GDP seems to be picking up. That seems to be relatively positive. Corporate earnings seem to be doing well. Unemployment seems to be waning. We hit that big peak, and it seems to be unemployment seems to be dropping a good bit. If any of you can find a job for my wife, who got laid off from Honeywell's aerospace division, of course, aerospace was one of the worst ones to get hit, and they laid off the whole division. So if you can find a place for her, I'd appreciate it, because she's driving me crazy at home. I'm just kidding, honey. I love you. So unemployment spiked in March and April, obviously, as we would expect, but that's starting to wane now, so that's good. One of the best slides that we have here, I think, and this is one of the things that for me sort of tell the story of why you want to stay in the market, is here, basically going back 40 years. This is the S&P 500, and these are intra-year highs and these are intra-year lows. So let's just pick on, I don't know, 1990 here. That's a bad one. Let's pick on 2005. So 2005, you can see that it ended the year at 14%. So the year of 2005 returned 14%, but there was a time during that year that it hit a low of -8. You see that? So you can see that with most of these, they had a positive year Obviously 2008 didn't, and obviously, the turn of the century didn't, but the rest of the years ended positively, even though if you look, some of them and almost all of them had a negative point at some time during that year. And if you see, some of those negatives were very negative. Look at this one. I don't know what year that is, maybe 1998, but at some point during 1998, it was down 19%, but it ended up positive 27%. So if there were ever an argument for staying the course and not making knee-jerk reactions, I think that's it right there. And of course, you don't know how this you're going to end up. I mean, if you look at 2008, at one point it was down 49%, but it ended up only down 38%. But then look at the following year, again, down almost 28% or 28%, but ended up 23%. So if you had dropped out, you had one bad experience in 2006, and then 2007, you had another bad experience, but you would have still ended up in a positive. So that's a great example for staying the course. It's also a great example for diversification. It's also a great example for rebalancing, all of those things which we are very adamant about, and we're doing for all of our clients without you having to worry about it. So let's go into our next stock, which is really, if you look at it, this is the S&P 500 for, essentially the last 5 years. We can see that, we've essentially doubled. We've essentially doubled in that amount of time, albeit there's been some serious drops there, right? And I know a lot of people who wanted to get out of the market during this period of time, but that was not a good idea. We have good positions. I just don't want to buy in right now because we're an all-time high, but our positions are great. So for a lot of our clients, for most of our clients, unless you know otherwise, we've been pretty much selling out of our high positions and moving into our treasury positions, not forever, but just for a time here for these PE ratios to normalize. When the PE ratios get back down to 15, that will be the time to get back in. So that's what we're doing. I just want to go back to, a lot of you know about the Austrian economics is one of the things that we really follow. And I came into contact with Austrian economics back in 2008, trying to figure out, actually, no, that was in 2001. 2001 is when I was exposed to it, about exactly 20 years ago. And it just, the things that I was being taught from our current Kool-Aid just didn't seem to comport with what I was seeing in my clients' accounts and what I was seeing in the marketplace. And I finally discovered the Austrian economics, and I'll be honest with you, I don't remember how exactly, but I'm I just searched around. And so I came across this guy named Ludwig von Mises, and I read some of his stuff, and it made so much sense to me, especially as I was watching the stock market, and I was watching, things go up and then things come back down, and interest rates go up and interest rates come down. And it always seemed like the Fed was chasing what was actually going on. And so, I started doing this research, started reading this, and then it made a lot of sense to me. So, the wave-like movement affecting the economic system, the recurrence of periods of boom, which are followed by periods of depression. Up, we're up, we're down. It's the unavoidable outcome of attempts repeated again and again to lower the gross market rate of interest by means of credit expansion. That's what we're doing. That's what we're doing. There's no means of avoiding a final collapse of a boom brought about by credit expansion, because credit expansion is not real. When the stock market is going up like this because new money is being created, nothing real is really happening. There's nothing real behind it. Take a look at this. This is the interest rate, the Fed funds rate. The lines that are running vertically, those lines indicate recessions. Okay, and these are the interest rates. Now note what happens right before a vertical line, which is a recession. And there was one right here too, and then there was one in here too. It's just they didn't last 20 months. We have to have a recession for 20 months before that actually gets on this chart. But their market drops. That's what I'm trying to say. Every time we have a peak in interest rates, they immediately drop the interest rate. Why? Well, because we had a market crash or a market significant correction. Why did it happen? Well, it was because they were contracting the money supply. So when the money supply is expanding, just like Professor Mises said, when the money supply is expanding, that is an artificial attempt to lower the rate of interest through credit expansion. And you can only do that for a certain amount of time. We're already seeing it occur where these treasuries because of the immense amount of asset expansion that we've had. There's just not enough demand to keep up with the treasuries. And that means the Fed's just going to have to print more money, which is just going to have to drive us into more inflation. So that means they're going to have to raise rates. So you have to ask yourself, well, what is it around us right now that we can see that would make us, well, or need them to raise rates? Because when they start raising rates and contracting the money supply, that's when we've got to be on notice. Well, here's what it is. The commodities. We've seen commodities in the last year or so rise by 2/3. And some of that's probably due to the supply chain. There's no doubt about it. That's probably true. But it also is probably true that there is a lot of money sloshing around, and commodities are one of the few things one of the first things that we see that really start moving, and we see that's occurring now. So that's a big concern for the Fed. The other thing is gold and silver. That's one of the things that they really watch. And you know, the silver market is highly manipulated. And that was one of the things that the Reddit group went after, was to try to run those shorts up, but that didn't work. It worked better for that other stock that they did, GameStop. But so commodity prices spiking like this by 2/3 is concerning, and I got to tell you, I've been saying this is going to happen for a couple years now, and it's finally happening. So good for me, I guess. But bad for the rest of us, or all of us, me too. So what we want to do, you know, is for all of us, is we need to make sure our investments are properly situated. And I can tell you that for our clients, we do this every single day. We're looking at it, we're thinking about it. The best way to be right now, we're not in any junk bonds, we're not in anything that's low risk or low credit quality. We're in treasuries. Treasuries did drop just a little bit. If you'll notice that your account didn't drop, because we're still in the very short end of our treasuries. The longer term treasuries drop more dramatically. So it's important for you to keep us in the loop with things that happen. And maybe you've decided, I tell you, a lot of people have decided to go ahead and retire earlier. I've got clients that are just, you know, hey, I'm going ahead and take my severance. I'm going to move to Colorado, or I'm going to go sell my house. I'm going to buy an RV. I'm going to RV around the country. I mean, it's happening a lot. And you know what? People are realizing that I had a family member that died. I had a cousin that died, or I know a friend that died, and you know, they were in sort of the golden times of their life. And you know what? I've never known anybody at the end of their lifetime that said, you know, hey, you know what? I wish I had worked more. I wish I had spent more time away from my family. You know, no, that doesn't happen. What you hear is, I wish I had spent more time with my family. You know, I wish I had taken those trips. I wish we had taken that cruise that my wife always wanted to take, or that my daughter or my mother always wanted to take. So the thing that we've got to do in our life, you and I and all of us, really, is to make sure that we stay healthy and that we have our loved ones, because that's really what life's about. You know, turn the finances over to guys like us and let us worry about that. But you need to focus on you, your health, and your family and your friends, because I have lots of friends that are like my family, and I know you do too. So, you know, before you sell that house or buy the RV, it would be nice for us to chat about it and see how that might impact your financial future. And of course, legal documents. We've been doing a lot of these lately, and it's important that you have a will. If you have more complex estate planning, a lot of you have a revocable living trust. I can swear by those. They do work. We've been using them. They're fantastic. And so it's just important to keep all that stuff up to date. I know that maybe some of your people on your medical committees, someone there may have passed away, or there may be a new person, or somebody in a successor trustee. We need to make sure that all your beneficiary designations are in place, that none of your beneficiary designations say your estate, because that becomes all taxable at once. There's a lot of different things that we need to do. And so I'm hoping that once you guys get all of your shots in order, we can get back together and cross all those T's, dot those I's, and have a cappuccino, because I'm hoping to put a new cappuccino in our office here soon for you ladies. Steps for us to take, you know, keep you informed. I think we're doing a pretty good job of that. The feedback I get is that we do a good job. If we don't, please let me know. Remember, if there's anything that's going wrong or anything that you're not happy about, I'm the guy you need to reach out to, because we take it to heart. And Kristen does, all of us do, but we all want to know. if managing your investments, taking care of that. You can see that PE is over 40. If you've got more than 50% invested in the market, then we really need to chat. Now is not the time to take on these additional risks. Well, we're going to stay on top of things, to stay on top of the market environment. As you can see, we're on that. We're not just taking their word for it, we're digging into it. You're talking about forward-looking economic indicators here. Well, what does that really mean? Well, 5 of them I really do believe are forward-looking. The others are not. They're just, here's where we are today. And anybody can tell you that. I'm going to take some questions now. The rest of you who feel like you've gotten your fill of this, thanks for staying. It was great to be seen by you, and hopefully I get to see you really soon. A big virtual hug to all of you. I do have about 4 questions though, and I'm going to go ahead and start with that, if that's okay. So please feel free. The rest of you have some questions or something pops into your mind, please go ahead and do that. So the first one comes from James Temple, Katrina Mabin's son. Hey Jim, hope you're doing well. Katrina, I hope you're on this. Given the recent volatility in the silver futures market, would this suggest a change to your strategy in the metals markets? No, not necessarily. The silver futures market, remember with those guys on Reddit, and they were, the silver futures have been shorted immensely. And most of that's been by, well, I don't really want to say, but you can figure it out if you Google it. So there's some silver shorts that are on there. I don't know when those shorts are going to come off, or what the point there is. My belief is that those companies are shorting silver because they're buying up the physical silver on the other side of the planet. That's what I believe. So let me just see if. So that doesn't change our strategy in the metals market. No, because we bought gold back in December before the COVID even hit, and I think we bought it around 1,700, and it's up around, well, it's up around closer, went up to 2,000. So we'll see where that goes. Okay, Paul asks, there seems to be an increasing level of outright speculation in the markets. That's absolutely true. Tying this to the rich PE ratios and greatly stretched valuations, do you feel we are now in the later stages of a melt up? And yes, I do. I do think we're in the later stages, because you can see people are already starting to talk about inflation, and they're already talking. A couple of the Fed governors are already mentioning the word rate hikes. And you remember that word taper? Remember taper tantrum? So, you got to remember, this house is built. This is a house built on cards. I really do believe it. And when it's like whack-a-mole, and all these problems happen. Look what happened. Oh, the repo market's rate spiked. Oh, we got to fix that. Oh, interest rates are spiked. Oh, fix that. Oh, we got to buy some more assets. Fix that. And you just can't keep it together. You cannot run an economy. That's the whole point behind the Austrian school, is that you got billions of people out there making billions of decisions. I've seen cars on the road that I absolutely detested, but somebody bought it. Somebody paid money for that car, right? You see it all the time. You see people wearing horrendous clothes, okay? And you're like, how in the world would somebody pay for that blouse? But they do. They pay, and they pay good money. It's amazing. What is your advice to prepare for the inevitable meltdown? Are there any data points that could help you prepare the investor for a downturn? One of the best things that I like is read Mises, MISES.org. Mises, they're fresh. I don't agree with everything, but it's a fresh outlook. It's different from everything else you're hearing, and at least it gives you a different outlook on things, and it can be fresh. You're not going to agree with everything. I don't agree with everything, but it makes you think, and it does give you a different perspective on stuff. I think everyone, and like the good Austrian I am, I think everyone should have some physical bullion. I think you should have some gold and some silver and some junk silver. Junk silver is not junk. It's just a 90% content silver. There were like quarters and dimes that came out before 1962, I believe is when it is. Bill Fiva is the guy to ask about that. But I have some of all of that. And, historically, because again, my wife's from Brazil. Brazil's currency has collapsed 8 times in the last century. And they've gone from cruzados to reals to, all these different things. And they call it something different each time. And then they just sort of start over. And And you've seen it in Chile, you've seen it in Venezuela, you've seen it in Argentina. It's happening all over Africa to like the nth degree. And so they just swap out one currency for another. And you had, $1,000 and now you have 100 Fed coin. That's probably what's going to happen, something like that. So I would always keep some bullion, and you don't want to have all your stuff in gold, because you got to have things that are going to be divisible, something that's going to be divisible. And I tell people, don't pay for numismatic value. Oh, well, this is the 1935. No. You just want bullion. And the bullion that I buy is silver eagles and gold eagles and silver eagles, U.S. eagles. That's it. Why? Well, because they have a U.S. face value on there. So like a silver eagle may be worth $20. Okay. Well, it says it's worth $20, right? So whatever the value of silver is, it might be $100, but it's still worth $20 because it's U.S. currency. And those are the only currencies or gold bullion that's available to own in sort of an IRA fashion. The other thing is everybody recognizes them around the world. You pay a little bit of a premium for those gold eagles, silver eagles, but they'll carry their premium throughout existence. I do believe that. Okay, a melt up. Yes, we are in a melt up. That is for sure. And it's very dangerous. We would feel comfortable about having a lunch and learn in October. John, thank you very much. I think October, maybe we'll try that. We'll see. Talk to the decision to take money off the table in January, and if there are any additional plans to do so in light of that. We've already taken off. We've done 10%. We've taken a good bit off the table. I think we sold a large portion of our equities just recently. I know we did. We'll have to, it's different for everybody because everybody's invested a little, not everybody's invested completely different, but some people are 85 and they only have 20% or 30% in the market. Some people are 60 and they've got 40. So it's a little bit different for everyone. Low interest rates are making it very hard to be a saver. That's a terrible thing. That's absolutely true. When do you think rates will? Well, yes, I don't think rates are going to be going very high ever again. John, I don't think we will ever see 5% Fed funds rate ever again. And the reason I say that is because if you look back at that chart and you can see that as interest rates go up, that eventually the market crashes. And if you look at what happened in 2007, it was 7.25 that crashed the market. If you look at what happened later on, it was 5.25. If you look what happened last year, it was just maybe, what were we, 3? So, when you have a larger economy like we do, a 1% interest rate hike ripples through the entire economy a lot faster and a lot more breathly than you would think. So I just don't think we're going to see higher rates like 4 or 5% again at the Fed funds level. I don't think we're going to see 4 or 5% CDs ever again. I just don't, unless we have a completely new currency, and again, we're probably going to be moving to some sort of electronic currency like a Bitcoin, but for US dollars, they're calling it Fed coin. And that was Jim's next question. Are cryptocurrencies, Bitcoin and the like, the new tulips? Yeah, and what Jim means, and thank you, Jim, that's a great reference to tulips, because a lot of you may not have remembered tulip mania back in the 1600s, 1640s in the Netherlands. Tulips were indigenous to Africa, and the Dutch discovered them. And they brought them back to Amsterdam, and they discovered that their soil, because they had a soil, it was very wet, so they had, that's Amsterdam, all those dams, they had to use dams to keep out the ocean, but they discovered that their soil was extremely suitable for tulips growing, and so they had all these different tulips. Look it up, Google tulip mania, and you wouldn't believe the prices of these tulips. So they would have a hybrid tulip and this Africanus violetus tulip. And these tulips would fetch the price of equal to someone's house. I mean, it was insane. And just like, all of those things, they eventually collapse. So yes, this is like a tulip mania where people are buying things that don't make sense. Are cryptocurrencies the new tulips? I think so. I have a few. I would not recommend people buy into that with money that they are actually serious about keeping. Okay, if you're willing to risk the money, it's like Vegas. If you're willing to risk the money, you just need to know that it's a risk. And so I've seen those things drop 70% in a day, and it's fun to gamble. If you like to gamble, put some money there, but just that's not money that you want to put in the college in the kid's college fund, and that's not retirement money, and that's not long-term care money. It's just gamble money. And if you do well, great. I've got some clients that have done very well, but do not take that as not a serious investment, not at all. Dawn and Irene, I hope that answered your question. Insight on the Bitcoin investments: do not touch it with money unless you're willing to lose that money, because you can lose 70%. And I get it. You see the headlines all the time about it's all new high. But remember, we've seen this before. Remember 2008? Remember 1999? The internet was a new thing. And so you could go on the internet and buy internet stocks, and that just exacerbated itself. A whole new industry and a whole new commodity at the same time. Incredible. But we know what happened. People lost 40, 50, 60, 70% of their investment. And a lot of those people were the people who got in late. Okay, it's late. Now it's too late if you're going to jump in those things. I would just, if you find a good investment, you like it, shore up some money, save your money, watch it. And then when you find a good price earnings ratio, there's no price earnings ratio with these crypto coins. There's no earnings at all. You're just a straight up risk. You just need to know that. You'd be better off going to a craps table in Vegas and playing the don't come, play on the side of the house. Once you get over the come out roll, you're just wanting for a 7. And guess what? 7 is the most likely thing to come out. So I'm not suggesting you do that, but the risk is you have less risk at a craps table than you do playing these cryptos. That's just the truth of the matter. What do I think of preferred stock? Okay, wait. Anonymous attendee. I love anonymous attendee. I have heard of the pension benefit guarantee corpus facing insolvency. Is there any truth to this? I do not know. It wouldn't surprise me that these guys are highly leveraged, because the problem with pensions is that people are just living way too long, and people are just living way too long. My grandmother, she was a Sears retiree. You remember what happened to Sears? And one of the reasons Sears went under is because they gave them very generous pensions, and she worked at Sears back in the 40s and the 50s and the 60s, and she lived to be 102, almost 103. So, and she was getting a pension the whole time. So it would not doubt me. I would not doubt it if pension companies were in trouble. I don't know anything specifically about this one, and if I did, I couldn't say anything. But I will say that that if we have a major downturn, there will be a lot of pension plans that are going to have problems. I don't know if you remember what happened, and I think it was 2008 when Delta filed bankruptcy. They filed reorganization, right? I had a client, he was getting about $130,000 pension from Delta. He lost it all. It went from 130 down to maybe 38,000. So can you imagine working for a company all your life? He came out of the military, that came out of the Air Force, worked for Delta as a pilot, worked for them for 30 years, comes out with a fantastic pension. All they have to do is file reorganization, and he loses the rest of his pension for the rest of his life. That's horrible. So you just can't trust anybody. You can't depend on anybody but yourself. You've got to take care of yourself. You can't depend on Social Security. You can't depend on the government to tell you the truth. You can't depend on these guys not to print just ungodly amounts of money to drive interest rates into the ground, so that poor people on Social Security who are living day to day on their paycheck, or just on retirement income. I mean, food prices have doubled. It's true if you go to the grocery store. And that's the thing that really hurts me, is just to watch these savers and these senior citizens struggle like this when they've given so much to our country. I was raised by my grandparents, if you noticed that. When is the shoe going to drop for the massive federal debt, Jan? That's a great question. I will say this. This is one thing that I've been thinking about a lot for a long time. Now, we are currently a little over 100% debt to GDP right now. So that means that our GDP, we can, $17 trillion, $20 trillion is what our GDP is roughly if we have a good year. That's roughly what our debt is. Okay, so we're 100% debt to GDP. People are still buying our bonds. So there's not a collapse in confidence yet. And I will tell you this, Japan has been running at 200% or more GDP for at least 10 years. And people will buy Japan's bonds even when they're paying negative rates. Negative rates. Makes no sense. But people will pay Japan to park their money there because at least Japan yen is safe. And Japan is one of the safer first industrial countries. So So, you know, theoretically, if we take Japan's example, we could double our debt and people would still buy it. I mean, that's just the theory. That's just a theory based on what Japan has done. Becky Jones, what do you think of preferred stock? I like preferred stocks, Becky. They work a lot like bonds. It's a little less safe than a bond. They usually pay a higher rate, but they work a lot like bonds. One of the things I really like are convertible stocks. Convertible bonds. Convertible bonds are a position that we hold in almost all of our client accounts. All of you, if you're a client of ours, you have those, and they're up 100% since we bought them back last March. So we're going to sell some of it because we're up 100%. And but we like convertible bonds because a convertible bond is a bond that will pay interest like a bond, right? A normal bond, but it has an option to it where you can convert it to stock. So if the stock price goes way, way up, like we've seen recently, you can convert that bond into stock. But if the price goes down, you don't convert it into stock, you just hold it and you continue to get your bond income. We like those a lot. There's just not that many companies out there that do it anymore. So, so that's something that we like. The last time the stock market had big drops, didn't the bond market also drop when taking money out? Well, that's true. In 2008, that's the first time when stocks dropped and bonds dropped also. We think that that was mainly because people were having to cover their stock losses. They were having to cover their stock losses and they were selling off the bonds in order to do that. In fact, we know that's the case because it was the big banks that were selling off bonds. And they were selling off municipal bonds and they were selling off corporate bonds. The only bonds that went up during that period of time, anonymous attendee, are treasuries. If you go back and look in 2008, 2009, the bonds that did very well were treasuries. The longer term treasuries were up 20, 30%. But yes, the other bonds, corporate bonds, municipal bonds, they were all down because the banks had nothing else but those to sell. They weren't getting any money in from their mortgages. All the mortgages were collapsing around them, remember? Real estate was in the toilet. They had no value there. So what did they have? They had they had corporate bonds and they had municipal bonds. And they just unloaded them in the billions. And that did flood the bond market and they did drop in price, but not the treasuries. The treasuries were up and that's where we are. We're in treasuries. Okay, last question here from Doug Wakeman. What do you think of cannabis stocks? That's a trick. Well, Doug, I just don't know. I don't know if they may be overbought, they may be overhyped. There's a lot of hype. If you go out to the West Coast, it's definitely a thing. You definitely see shops, you definitely see commerce, there's definitely demand. I think that they're probably long-term, probably going to be a good buy. But I think at this point, there's still so much uncertainty around what are the federal guidelines, and how does that work with Canada and how does that work some of the states? I think it's inevitable, honestly, that all the states are going to legalize it because you just can't have people flying from, Portland through Atlanta to Maine and then bust them here in Atlanta. I mean, it just doesn't make any sense. So they're probably going to have to just legalize it across the board. And I've been to Amsterdam. I see they make a lot of money over there on that stuff. And I've been to Seattle and they make a lot. It seems like they're making a lot of money. So I think there's something there. It may be too early. I don't know, but I definitely think it's something worth watching. Is it something that we're going to interject in our portfolios? No, because we follow Morningstar. And if Morningstar buys one of them, we're going to follow them. So there definitely is demand for it. That's for sure. People have been smoking cannabis since Mesopotamian times. It came out of, I guess it originated in the Caucasus. Okay, the impact on falling bond prices on the equity market, asked Jan. Impact on falling bond prices on the equity market. Falling bond prices on the equity market, well, you can see that the spike in the bond yield scared the market. So yeah, I think that's scary. But really, if it happens, I mean, if people are selling treasuries to buy stock because they're bullish, well, that's a positive thing for the equity market. If people are just selling stocks and bonds altogether to go to cash, well, that would be negative. Right now, what we see is people still buying stocks. So I think that the falling bond prices have to do with a shift in attitudes of amateur investors primarily to buy in equities. They're just, everybody's chasing the herd now into the equities, and to do that they got to sell some bonds over here. And I think that's what's happening. I predict, and we think that going forward, that because of interest rates as low as they are, that you're going to see value stocks do better. And value stocks are those stocks that pay dividends, like Johnson & Johnson, AT&T. I'm not saying those are the ones to buy, but those stocks pay dividends. Southern Company, they pay dividends, and they've been around for a long time. So if it were me, and I'm I say I'm a 75-year-old. What do I want? Do I want to put my money in cryptocurrency? No. Do I want to put my money in Tesla? No. Do I want to put my money in Johnson & Johnson? Yeah, I might, something that I remember is from being a kid, Nabisco or something. I mean, those things that, they've been around forever. People know them. Colgate, you use Colgate every day if you're like me, and maybe somebody uses Crest. I don't know. Hopefully we're all using something. And those things they just continue. Everybody eats, and we all need to eat every day. So it's a habit I've really gotten into over time. So let me see, one more for Judy. Thank you, Judy, or thanks, Kevin, from Judy. Thank you, Judy. I appreciate that. You guys are always so awesome, and I feel very, very close to all of you, and I hope that we get to see each other soon in person. So with that, I'm going to say adieu, and I hope you have a wonderful, wonderful month, or a wonderful day, and a wonderful week. And until we see you next time, this is Kevin Metter signing off, and with big hugs. Bye-bye.